Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with the yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
To Macro Mondays. My name is Andreas Steno, and I'm all by myself again this week, as we've allowed my co-host Mikkel Rosenwald a few weeks of paternity. We have a very interesting macro backdrop to discuss again today, especially after that relatively hot labor market report out of the US on Friday. And in this week's show, we'll first of all discuss whether we're currently stimulating an already okay economy in the US. That's a very interesting backdrop and potentially one with very high returns ahead. And then we'll discuss the liquidity stress we saw last week and whether that will lead to decision-making by the Federal Reserve already in November. And of course, the China frenzy seems to continue. Does this China story have legs, or will we have to see some sort of retracement lower in Chinese assets over the coming weeks? And then, of course, it's a big inflation week, both out of the US, but also elsewhere over the coming 5 days here. So let's have a look at it. I'd like to start with this quote. When the government tells you to trust the government, it's time to not trust the government. I guess that's very telling given the labor market report on Friday. Is it fair to assume that the US labor market is actually rebounding relative to what we saw over the summer? Or is this report a fluke, as was reported on some of the more mainstream blogs out there? I have my doubts on whether this was sort of the full picture. When we look at the labor market report on Friday, we obviously had a monthly job creation that was higher than expected by more or less all respondents in the Bloomberg survey. I think we had one economist expecting more jobs than what was added. But it kind of rhymes with the typical election year seasonality, meaning that it could actually be that the labor market will see a decent rebound into the late innings of the year. And let me try and explain why. So what we typically see in an election year is very weak hiring ahead of the election, while we see a strong hiring after the election. And we also typically see some sort of catch-up effect right around the election date. And I guess it kind of makes sense, given the outcome space that we see ahead of this election this year, to postpone some of the decision-making around hiring if you, for example, run a company within a sector that is really sensitive to whether Kamala or Donald Trump wins this election.
You want to unfuck your shit? This
is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
And take the example of an employer within green tech or within wind turbines or some similar sector to that. Would you take a big decision to hire a lot of people ahead of the election, given the risk that, for example, Donald Trump pulls the rug from under your sector from a political perspective? I don't necessarily think you do so. So it could actually be that we get like a catch-up effect after that election, given that the uncertainty is sort of removed after the election date. At least that's what we've seen in other election years, and it could very well be something that we'll see again this year. If we look at the details from the labor market report last week and also look at it in the context of whether we are currently stimulating an economy that is already doing okay, I think it's worthwhile looking at sort of the sector decomposition of this labor market report. And we actually got a pretty decent rebound more or less across the board. And if you look at the non-farm payrolls, it wasn't really driven by the government adding jobs. So you have that towards the very bottom of the panel showed here. The government added jobs, sure. And if you look at the household survey, the government added a lot of jobs, but the household survey is kind of catching up to the non-farm payroll survey. You need to remember that we have basically two separate surveys in the US trying to measure the same thing, and we've seen a large divergence between the two over the course of the past years. Now it kind of seems like the household survey is catching up to the non-farm payroll survey, not least because the government added a lot of jobs in the household survey, but it wasn't really what added a lot of jobs in the non-farm payroll survey. So we need to look at the non-farm payroll survey first here, and we had a pretty broad-based increase across service jobs, and that's been the main engine of job creation over the past year. We see a job creation in leisure and hospitality. Again, we see a job creation in education services and stuff like that. So to me, this is a pretty decent report. You simply have to admit to that. And we got job creation without really any major contributions from manufacturing either. So there's room for improvement here if manufacturing also starts rebounding, which is something that we really haven't seen yet. And if we look beneath the hood, we had a couple of very weak non-farm reports over the summer. We actually got revisions to those reports in an upwards direction also on Friday. But still, if we look at the broader trend, I like to look at the annual rolling revisions of non-farms, and it still seems like we're stuck beneath zero here, which is typically a sign that the labor market is cooling. It's not dramatic if you compare it to like earlier coolings of the labor market, but we're still beneath zero on a 12-month running window, meaning that the trend is weakening. And I still think that's the case even after seeing the numbers on Friday. So yes, it was better than feared. Yes, this is something that kind of leaves the Federal Reserve at crossroads in terms of defining whether they need to cut by 25 basis points or 50 basis points every time they meet. This is a 25 basis points report without a doubt, right? But the trajectory is still towards softer labor market figures. And therefore, I think this cutting cycle will very much remain intact despite what we saw on Friday. Remember that the Federal Reserve has now set a direction. They want to cut interest rates, and one stronger than expected labor market report will not alter that direction. It's a super tanker that they've turned in the direction of lower interest rates, and it will take a lot more than what we saw on Friday to really guide that super tanker in other direction. And when we look at the forward-looking indicators for the job market, I still think it's likely that we'll see higher unemployment going into 2024. Again, nothing dramatic, but we'll move towards the 5% handle, most likely when we look at, for example, the forward-looking evidence from consumer confidence surveys. So what I use in this model shown right now on the screen is the spread between expectations in the consumer survey on whether jobs are easy to get or not, and then also the expectations on whether jobs are hard to fill. And when you look at that spread, it is clear to me that the labor market is at least not strengthening here. And that's typically a sign that unemployment is ticking up on a trend basis. But again, here, not in a dramatic fashion. We're slowly getting towards looser conditions in the labor market. And that it's exactly the kind of excuse the Fed needs to continue cutting here. When we square that with what we see in the real economy right now, I think it's first of all fair to ask the question whether the Institute of Supply Management has gotten anything right since 2020. I mean, Both employment surveys released by the Institute of Supply Management last week, both in manufacturing and in services, pointed towards a decline in employment. We obviously didn't get that in the non-farm. So at least they're struggling with kind of fully depicting what's going on in the US labor market. But we also got a big divergence between manufacturing and services again last week. Manufacturing printing very weak and services printing better than feared, exactly in line with what we thought was the most likely scenario. What scares me a little bit about this cocktail of a strong service sector and a weaker manufacturing sector is that it's typically a highly pro-cyclical spread. So you want manufacturing to rebound faster than services to really turn upbeat on the economy overall, since manufacturing is more sensitive to the global environment, it's more sensitive to interest rates, it's more sensitive to inflation, and so on and so forth. So typically we see a strong connection between returns in equity, crypto markets, and so on and so forth, to the spread between manufacturing and services. So when manufacturing rebounds more than services, it's a strong hint that we'll see strong returns. And right now we're kind of seeing the opposite from the real economy. But what about looking ahead? Well, here's one of my favorite long leads for the US economy. So what I do here is that I look at the yield curve in the US 12 to 15 months earlier versus the subsequent move in ISM manufacturing. And when ISM manufacturing rebounds a lot, it's typically a strong sign that we'll get solid returns across the board in risk assets. And we've now seen almost a 2 percentage point slide on average across the yield curve in the US. If the Fed continues cutting, we'll likely see that 2 to 3% drop in yields. And that is very stimulative down the road, and something that is typically received well by manufacturers, by the Russell 2000 companies, and all of the companies that are not included in the Max 7, right? They've been telling the Federal Reserve to cut. They've been moaning about tight financial conditions throughout this high inflation, high interest rate period. And now they're getting those cuts, and they're getting softer conditions measured by the yield curve. And that's something that spills over to a stimulative environment into next year. So I don't think we're too far off a major rebound in ISM manufacturing. At least it's clearly on the cards in 2025. And that's very promising when you look ahead for returns. Judging from this very simple correlation shown here, you should expect a 2% drop on average in the yield curve to subsequently spill over to a 20 index point increase in ISM manufacturing, taking us above 60 in a year from now, if you trust this correlation. And I think this is one of the best leads you have in the model package, basically, for the US economy. So sure, there's some weakening ongoing in the labor market, also despite the stronger signs we saw on Friday. Sure, unemployment could go to 5% or thereabout, but the Fed will cut into this. And I still think that's the overwhelming conclusion, despite what we saw on Friday. And it will allow for a cyclical rebound into 2025, which is much needed given the lack of a rebound seen in the manufacturing sector. So yes, we are probably stimulating an already okay-ish economy, which is ultimately very good news. And maybe we'll even see liquidity additions alongside this. We saw some clear liquidity stress around the quarter turn early last week, especially around the last trading day of September and the first couple of trading days of October. We saw that stress in SOFR markets in the US. So when you look at the spread between SOFR and Fed funds, you have a pretty decent gauge of whether liquidity is readily available for private repo markets. Remember that the SOFR rate is a repo rate, while the Fed funds rate is a rate that is tied to the amount of reserves available for transaction between banks with access to the Federal Reserve, while the SOFR rate is also used for transactions vis-a-vis, for example, hedge funds repoing their positions to gain liquidity to buy more, right? Levering up their positions. And what we saw was a spread increase to more than 20 basis points around turn, which is the nastiest quarter turn that we've seen in a long while. And it felt kind of reminiscent of September 2019 in repo markets, just on a smaller scale, obviously. The lesson learned from September 2019 is that the Federal Reserve is now much more attentive to stuff like this. They've basically been talking about when to expect this to occur since sometime during the spring. Remember that Lori Logan, one of the key members of the committee, already started talking about adding liquidity to markets when the overnight reverse repo facility, so basically the opposite of a repo facility, when that facility closed in on zero. I think we are closing in on some sort of natural floor level for that facility already now, meaning that this is on the radar within the committee. We also saw Michael Barr, the head of supervision, talking about trying to add liquidity via the discount window a few weeks back. So this is something that will already be discussed in the meeting minutes released on Wednesday, and likely a topic already for the November meeting at the Federal Reserve. Now that we've seen some clear liquidity stress last week, we have seen a quote-unquote normalization of these spreads after liquidity improved after quarter turn. But the Fed dislikes this kind of stress, and they dislike the mere risk of having to step in via a repo facility, as they ultimately had to do in September 2019. So my best guess is that they'll try and address this up front without ultimately having to enter some sort of stressed scenario before they act. And therefore, liquidity will likely improve a lot this quarter. We have two potential liquidity-adding facilities being discussed now. First of all, this discount window discussion. So Michael Barr mentioned the discount window as a potential liquidity-adding facility for the upcoming quarters. And what the Fed will likely try to do is to remove the stigma of using the discount window. The discount window is typically used in stressed scenarios. But if they alter the rules, they could basically force banks to use the discount window on a running basis, for example, by telling them to always utilize the window on a running basis. For example, they could tell them, okay, you need to use this window for X% of your uninsured deposits. And if they implement such a rules change, it basically means that banks will have to park, for example, US Treasuries as collateral, and then they get liquidity in return via the discount window. And that is some sort of light QE style scenario where the Fed forces banks to put up collateral at the discount window and get liquidity in return, meaning that the Fed will receive bonds and provide liquidity in return in this facility. And on top of that, we know that the Treasury will have to add liquidity into the crossover date early next year because of the debt ceiling. So we have two potential liquidity-adding facilities working in tandem into January, February next year. And I personally wouldn't rule out that we get almost $1 trillion of liquidity incoming just because of the drawdown of the Treasury General Account ahead of the debt ceiling and the crossover date, and because of an alteration of rules for the discount window. So rate cuts, liquidity additions into an economy already doing okay-ish. I think this ultimately sounds very bullish. Alongside this, we still have the China frenzy ongoing, at least as of Monday morning. It seems like China is still doing very much okay in asset markets. And I think this chart is very telling in that regards. We've had a very decent performance in other Asian regions over the course of 23 and 24, not least Japan. We've seen kind of a reversal of Japanese trends over the course of this China frenzy, while Hang Seng, as you can see in light blue here, is through the roof. We're talking a 5-6 standard deviation move on the back of this pamphlet of stimulus measures announced by the People's Bank of China and the Politburo a few weeks back. I'm of the view that we probably need to see a continuation of stimulus measures from China to really keep this frenzy going. This chart is based on the retail flow in the US into Chinese assets. And as you can see, we've had billions flowing into Chinese assets. So basically, you guys out there buying Chinese assets via various ETFs in the US. And that's very much out of the ordinary. We've seen like a steady decline in flows into Chinese assets from US investors and European investors. But now we've seen that major influx. And the flow is fading now. So we're seeing a decrease in the day flows. And that's typically a little bit worrying for the momentum in a frenzy, right? You want to see a continuation of flows for it to really be underpinned. And therefore, my expectation is that there will be a lot of pressure on Chinese authorities to continue easing into this for them to sort of keep the momentum ongoing. To take a very practical example of this, they announced a 113 billion equity stimulus fund. And what we got in response from markets was plus 2 trillion increase in market cap. So they really got bang for the buck here. I have to admit that, and probably also more than I dared expecting. But still, 130 billion leading to a plus 2 trillion market cap increase. It probably also means that you have to feed the momentum on a running basis for it to continue. And currently, we're still kind of awaiting new signals from the Chinese administration after the Golden Week last week, where they were off. I'm of the view that everything ongoing right now with potential liquidity additions in the US, paired with more running stimulus from China, is that it's basically mostly good news for intangibles. So equities related to software technology, crypto, for example. Hang Seng is doing much better than peers in mainland China, more related to like the physical economy. And I guess the reason is that the stimulus currently aimed at the financial economy more than the real economy, in the sense that we're not talking about aid packages for the construction sector. We're talking about trying to mitigate the issues of loads of unsold homes being stuck on balance sheets of developers, etc. But they're trying to move that a bit onto regional government balance sheets. But we're not talking about a major signal for developers to start building again. So what I'm trying to say here is that the commodity space is probably not on the receiving end of a lot of inflows, ultimately in physical terms. You're not going to see a frenzy of buying in copper, iron ore, and that kind of stuff, because we're not seeing a revival of the infrastructure and building pace in China. We're rather seeing an underpinning of the financial economy and underpinning of asset markets. And I think there's a difference between tangibles and intangibles in such a scenario. And also rhymes with the liquidity addition in the US being better news for intangibles than tangibles. Having said that, we're obviously going to watch the inflation release out of the US this week. It will be a key release, even though the Fed has sort of moved towards the labor market being the main center of attention for their reaction function. But what I'd like to stress is that I think inflation is going to print relatively hot in September. So the release here in October is based on September's numbers. If you look at historical hit ratios of betting on higher than expected inflation in September, we're talking about a very decent hit ratio compared to betting on lower inflation. And then the picture kind of reverses into October. So what I'm trying to say here is that the squeeze that we saw in interest rates on Friday could potentially increase its momentum this week, with inflation printing harder than expected. So maybe this is not the perfect week for risk taking in that regards. But still, we're slowly but surely moving towards a scenario where it's more likely that growth rebounds into next year. It's more likely that liquidity rebounds into next year. And it could happen in conjunction with some sort of stabilization or maybe even increase in inflation. So what we do here at Steno Research is that we try to always map these probabilities on a running basis. As you can see, we've seen an increase in the probability of rising growth basically through September and into October. I think this is one of the reasons why we're seeing some more positivity out there. We're seeing an increasing probability of rising inflation, but we're yet to see that move today in the rising probability of increasing liquidity. But I expect that to happen through October, and I expect that to happen through November and December. So all of a sudden, we could be stuck in what I call an up scenario. Inflation up, liquidity up, growth up. I think the dark horse is that inflation recedes even further, and then we could be what I call a gung-ho scenario, where inflation is going down, growth is going up, and liquidity is going up. So I think there are reasons for optimism now. And what we've done is that we've leaned towards intangibles in this environment. We've taken a bit of risk off in our fixed income portfolio, simply to acknowledge that the curve steepens now, that there's a risk of higher long-term bond yields, especially while the Fed will still cut into this okay-ish scenario. And that is ultimately re-inflationary in nature if the Fed cuts into an okay-ish economy. And it seems like it is very much what they're going to do. So I'll leave it at that for this week. And as a reminder, our typical disclaimer for this show, delivered by the Italian football manager Gennaro Gattuso. Our ideas might be
sometimes may be good, sometimes may be shit.
Always important to have that disclaimer in mind, but there are reasons to cheer up, and we'll be back again next Monday with my co-host Mikkel Rosenvold, also back behind the microphone together with me. We'll see you again then soon.
Owning gold and silver can be a great way to protect your wealth from inflation. The only drawback is that your metal just sits there collecting dust or racking up storage fees. If you started with 100 ounces, you may end up with only 95 ounces 10 years later. But what if your gold and silver could do more? What if you could grow your ounces just like you grow your other investments? Now you can with Monetary Metals. Monetary Metals' innovative platform connects gold owners and businesses to provide clients with a yield of their gold and silver paid back in ounces of physical metals. You can earn up to 5% in the precious metals program, and if you're an accredited investor, you can earn 12% on your silver right now in the latest bond offering. All the interest is paid back in physical ounces of gold and silver directly to your account, so your total ounces grow and compound year over year. Go to realvision.com/metals to learn more about how you can make your metals work for you today.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.